Ladies and gentlemen, welcome back. I'm very pleased to see we have a very exciting panel to try and keep you awake after all food. There's obviously been a lot of discussion today about the geopolitical context of this meeting, and it's obviously very much a mining week in London this week. I think we're all very conscious from our different areas of practice of the kind of elements involved in investing in the mining industry. Ultimately, of course, natural resources are a key element, macroeconomic and geopolitical circumstances. From our perspective, the legislation, the rule of law, including the mining regime, stabilization, other issues of that sort, general taxation, whether they're free trade economic zones, labour force, access to power and infrastructure, and how projects may involve both mining and the creation of the infrastructure to power mining operations and provide for the transmission of the product, and processing of the product. The ability of people to get into the country, the ease of doing business, merger policies, approval consents, the efficiency of the bureaucracy, and indeed the approach to nationalism and the protection of these hugely valuable resources for their own communities, and how that is balanced with the need to get international and domestic investment. The location and trading regimes are hugely important. Against that background, I'm going to fire a series of questions at members of the panel. They've had some advance notice of these, but also very much encourage participation from you, both in terms of questions and if you have views on what we're discussing, your thoughts would be valued. So I'm going to start with Ayuna. I'm not going to cover everybody's CVs because you probably know most of them, but anyway, the CVs are set out in the brochures. Ayuna, do you want to talk about IPOs in the mining industry and how you see the current situation of the pipeline, both for the LSE and international? Perhaps as part of that, you could also comment on the KMG domestically.
Thank you, Simon. My name is Ayuna Nishai. I'm head of Europe Primary Markets on the London Stock Exchange. I've been covering Central Asia for the entirety of my career at LSEG for the past 12 years or so. And my primary objective is, of course, to bring listings and IPOs to the London Stock Exchange. So it's interesting that the conversation about the mining industry has been, I think, has been at the forefront of the agenda when we talk about sustainability, climate relations, financial disclosure, and so on. And there's been a lot of sort of pushback around the mining industry. And what's really important is, from the London Stock Exchange perspective, given that we have 185 mining companies worth nearly $600 billion US, to really ensure that mining companies are not seen as doing bad things per se, simply because a lot of those businesses are doing their utmost to become more environmentally friendly, to become more sustainable, and implement ESG policies. So, and that on top of the need for the electric vehicle EV industry to utilize certain metals, technology industry requiring rare earths metals, but also, of course, the renewable energy industry requiring metals to build new wind power plants and so on. It's really important that we bring metals and mining companies, continue bringing them into the conversation. In terms of the pipeline and outlook for IPOs, this year we've had 5 new companies listed on the London Stock Exchange. Very small capital raise. One of them is, for example, is First Tin. So it's really interesting to see that all the capital raisings are small. Listed companies actually have an ability to also go back to when times are tough, go back to the market and actually raise further capital pretty seamlessly and efficiently when they need to do so. The pipeline actually is looking really good for next year, including some of the larger sized businesses, especially from the region that we're covering today, Eurasia. Just to go back to the point and we'll finish off here for now, around Kazmunay gas. Kazmunay gas is an oil and gas company. It's also natural resources, but it's from Kazakhstan. I think that's really relevant from the regional perspective. So they announced their pricing a couple of weeks ago. Actually, we did a Kazakhstan investment forum on the stock exchange where the owners, as another sovereign wealth fund, announced the new price. And it is due to be completed, and the Kazmunay gas is due to be listed on AIX, the Afghan National Exchange, on the 7th of December. What's interesting is that chairman of the Single Kazan said that they will also do an international portion, and that's really important for us. So hopefully that's going to happen in London certainly. But just wanted to say that despite the massive energy crisis that we're seeing, despite the war in Ukraine that's happening, we're seeing a very healthy pipeline for next year. There will be also activity happening that's in Central Asia, in the regions that are directly impacted by global economy.
Thank you very much, and I'll come back to some further questions in a minute. First, for a large institutional investor like Devon Capital, could you comment on really two issues initially? What makes a jurisdiction investable, and within that, what makes a company investable? And an associated question, there's obviously a lot of discussion about ESG as a topic now. And how do you factor that into your investment decisions? Do you see ESG as something which will enable some compromise on return? Or would you see that good ESG practice would typically have a positive effect on return without the need for any qualification?
Well, these are three pretty comprehensive questions. How much time have we got?
No more than 3 hours.
Okay, well, let me just try to be short and sweet in my answers. So what makes a jurisdiction investable? So I come from the perspective that we're a very large institutional private equity firm, right? So we've probably, with development capital, built up more than 70 natural resources companies over the last 16 to 18 years. That's oil and gas, mining, renewable energy. I'm personally a partner in Denham's Metals and Mining Investment business. So as a starting point, we invest globally, right? So I think that is a first comment. So we got more than 60 natural resources jurisdictions to choose from. So that's the first comment. So there's not one continent or one jurisdiction where we have to invest. So that's just so. When you build a portfolio, as a matter of principle, only a small percentage of that portfolio can be high-risk countries or countries that are perceived to be high-risk. When you go to high-risk countries or countries that are perceived high-risk, obviously got to achieve higher returns. That's stating the obvious, right? And so then the question is, what are the criteria that make a high-risk country still investable for a foreign investor like us? So I would say, when we do this analysis, there's probably two areas that we focus on. One is the ability for the companies that we invest in to be able to genuinely operate without corruption, paying bribes. How do we arrive at that judgment, whether that is the case or not? I mean, obviously there's all these independent risk advisory firms that you can hire. We all do that, right? But that usually only gives you a fraction of the real answer. So we then typically spend a lot of time in a given jurisdiction before we invest. speak to a lot of companies who've been there for a long time, etc., etc. So nothing replaces actually the value of extended personal fact-finding on the ground. So that's first one, ability to genuinely do business in a non-corp manner. So that's a non-compromisable. The second one is, and this is very different to what a unit just described, because we come from the perspective of public market investors, right? We are private equity investors, so we typically own very, very large chunks of these businesses, right? And mining is a technically very complicated business, where, frankly speaking, when you build those mines, so we finance the development of new mines, 90% of the time, they're negative deviations, where things take much longer, they cost much more. This is a technically complicated business. It's not easy. The average capital overrun over the last 10, 15 years in mining is probably close to 55%. Over the last 30 years, it's been 25% or so. So the reason why I tell you this is because as a very large investor, when things do not go according to plan, especially when things don't go according to plan, you got to have the ability to take control and actually implement corrective action. So that brings me to the next non-negotiable criteria. If the political, legal reality in any country, if necessary, prevents us as an investor from taking genuine control of the business to rectify a problem, that makes that jurisdiction, from our point of view at least, uninvestable. It's that simple, right? Because our experience is when, forgive my French, when the shit hits the fan and things really don't go according to plan, if you cannot take control and impose a corrective course of action, you're quite likely to lose all your money invested. So,
can I just pick you up on one point there?
Absolutely.
When the aforementioned hits the fan,
yep.
There will be a regulatory background, and in the vast majority of jurisdictions, there will be sort of merger control issues, whether they are enhanced for strategic resources or whether they just apply to substantial businesses. To what extent would the existence of merger controls or state preemptions, these sort of things, fall within the category of, you just referred to, making things difficult to invest?
If the state does not allow me, in a worst case, to take control of an asset, that country is non-investable. That's simple. And the truth is that in the significant majority of mining jurisdictions in the world, a foreign investor can take control. So what you just described is actually only applicable to the minority of jurisdictions where attractive mining assets are, right? There's actually probably only 20 or so jurisdictions in the world where a foreign investor cannot take control if necessary. We're not control freaks. What I'm just saying is when things do not go according to plan, you need to be able to kind of impose corrective action, right? And where you can't do that, then you can't invest because you're not able to defend your capital, right? The second question was what makes a company investable. Well, again, first of all, in metals and mining, you gotta be in the lower end of the execution risk. That's a technically complicated business, right? So, refractory ores, no. Very complicated metallurgical downstream processing, no. It's like you go to the casino, right, and you play blackjack, right? You turn the cards, right? And if you flip the cards, the more cards are stacked against you, the more likely is it as an investor you're gonna lose your money, right? So you flip the first card. Okay, geology is very good, high grade, large deposit grade. Flip the second card, very difficult metallurgy, difficult to process. Let's look at the third card. If the third card then is a difficult country plus difficult metallurgy equals no, not investment. So all I'm saying is you can have a complicated project in a very easy country, but in a more difficult country you can only have an easy project. But not you can't have a complicated project in a complicated country. These all statements made based on more than 20 years doing of what we're doing, right? So sometimes you have to arrive at decisions in a fairly simplified manner. But what makes mining projects investable? Yeah, this sounds like a broken record, but it's the truth. It's gotta be, high grade, low cost, long life, Are there many of these assets out? And by the way, if management know what they're doing, that would also be great, right? Which frankly speaking is also not the case in the majority of cases, unfortunately. But Are there lots of such opportunities? No, there are not, right? Does that matter? No. I don't need to do a lot of deals. One deal every 2 years or so might be enough. So, you know, it's more important. It's actually always good. It's better to lose a good opportunity than actually to invest in a bad one. Because having lived through a bunch of workout situations in my life, probably responsible for some of my gray hair, I'd actually like to avoid those as much as possible. And ESG, look, ESG in mining, we look at it from 2 points of view. First of all, without metals in mining, without a lot of more metals in mining, there is not gonna be an energy transition. There's just not gonna be, right? The raw material intensity of the energy transition is actually quite comparable to the industrialization of China in a way, right? I mean, you know, electric vehicle needs 5 times as much copper as internal combustion engine, right? Renewable energy needs truckloads of copper and more complicated metals like everything from boron to earth elements, etc., etc. So, in some metals, you need 800% more annual supply than is present today over the next 15 years. Which, by the way, I don't think is achievable. That's never been achieved in history before, but put that aside at the moment. So I think the first ESG angle is, and I know that metals and mining in some ESG camps has a pretty bad rep, right? But the first statement is, without a lot of metals and mining, without a lot of more metals and mining, there is not going to be an energy transition. It's just that plain simple. The second one is, can you build mines in an ESG-friendly manner? Yes. I would actually go as far as to argue that actually ESG is not new to metals mining at all. It's just a new buzzword, right? Because in the mining industry, a positive social operating license was always a key enabler, right? So even 10 years ago, when nobody knew the abbreviation ESG, right? If you didn't do the right thing for a community in Peru, they would block the roads and your project wouldn't go anywhere, for example, right? So you always just need to do always needed to do the right thing from an environmental and community point of view, right? Today, that's just a fashionable word called ESG, right? But historically, in order for mining investment to succeed, you always needed to do the right thing, right? I mean, give you an example. I mean, we have in DRC, by the way, our riskiest investment from a country point of view, right? People said, is this not a reputation risk? Well, no, it's for the first time ever a school, for the first time ever a hospital, where we are approaching this. First investment in the area in 25 years. For the first time ever electricity, for the first time ever a cell phone signal, etc., etc., etc. Right? So it's a positive story all around, right? It depends on the investment, but metals and mining is certainly not contradictory to ESG, a responsible investment. Does it go at the expense of returns? No, it usually doesn't.
Thank you very much for such a comprehensive answer to that rather complicated question.
I mean, the more detailed answer would have taken 3 hours, so I tried to give you an executive summary of my thinking.
It was a very good executive summary. I think your key point about how many companies and mining operations will tick all the boxes for you is a challenging one. But thank you very much. We've already heard today about the importance of export credit as part of a financing package made available to mining companies. Could you comment on what your criteria are for granting export credit, and also what analysis as an export credit agency you undertake of the viability of the project and of the various companies involved in the project?
Sure, thank you. Well, thank you, Simon, first of all, for having me at the panel, and to us, the conference organizers here. It's great to be finally at an in-person surrounding and setup. It's a good change. So yeah, I think you've heard through Iona and the equity side, but talked about some of the considerations that they keep in mind. I come in on the debt, with a debt outlook, and we complement the equity investors by making sure that where almost always there will be a debt component to capital investment programs in the mining industry. But where there is a scope and element for our export finance cover, we can come in to ensure that the financing for a mining development, whether it's greenfield or brownfield, is done in a cost-effective manner. We are always relevant, in my view, but particularly when economic times are a bit uncertain, as we seem to be heading at the moment, or very much are at those times. As an export credit agency, we come into our own when the world is turbulent, and there is there is greater risk aversion in the commercial markets. A risk appetite gets curtailed. That's when because we are not just facilitators of debt financing, we come in with British government support. So we add in the element of British government support to provision of debt for projects overseas. Which is why, if you'll see at UK Export Finance's sort of empirical graph, our quote-unquote best years are during times of economic recession. And the reason for that is that we are there to cover the market gap. When the market does not need us, we are happily sitting in the background. But when there is a shortfall, either private investors on the debt side, whether it's bank or capital markets, they might not have the appetite for a particular market. They might have the appetite, but not to the amount that's required. They might like the company, they might like the project, but the pricing is not quite right to make it commercially viable. That is when we come in. So in terms of criteria, the fundamental one is, so to speak, from a philosophical standpoint, is we are there to solve for a gap in the efficiency of the market, and that's where we step in to help the private stakeholders get a particular project over the line. What we are looking for, just then getting into the more pragmatic and practical matters, is, as our name implies, we are looking to promote trade from the United Kingdom. So we are a government department. We like to think of ourselves as a commercial department of His Majesty's government now, but our objective is to make sure that we play a role in facilitating international trade between the UK and our partners overseas. So how does that come into form? How does that come into shape? If there is a mining project that is being developed in Kazakhstan or Uzbekistan, we just to think of a couple of jurisdictions that we have on our radar at the moment with active projects. If there is scope for UK procurement of goods and services in the construction of that mine, that could be kit, mechanical equipment, advisory services, Norton Rose's consulting advisory, legal services in a particular project. We will count that as what we call UK content, and as long as that UK content is 20% of the funding requirement, then our financing is actually 4 to 5 times the actual amount of the UK content. So project sponsors obviously find that compelling. Contractors who build these mines, they get particularly fascinated by us because they are thinking, okay, as long as I procure 20-25% from the UK, the rest I can secure from other places, but you will still finance the vast portion of our mining project. To which the answer is yes. That funding can come in a variety of ways. As I said, it could be a new mine, it could be an existing mine that's going through a refurbishment. So UK content is the second criteria. The third key one is the credit risk, because since we are on the debt side, we don't take, we will effectively look at a particular proposition through the lens of a credit risk in the world. So that's where the devil in the detail practically comes in. We are happy to look at project finance structures, corporate risk. Some strategic projects have sovereign government support that work for us, but we will need, because while we are there to support international trade, the second qualifier of our mandate is that we need to do that at a no net cost to our taxpayers here, and for that the credit risk assessment becomes key. I'll stop there now.
Well, as a taxpayer, that's entirely honourable. Interesting sort of relationship between what you've just been saying and what Bert was saying, because clearly this idea of the gap is something, and if we had our colleague from EBRD with us, I would be asking them a similar thing. I've heard EBRD, and I know there's EBRD representatives here who can tell me that I'm completely wrong, but I've always rather viewed EBRD as an element of taking some of the political risk element of an investment decision. I'm conscious this is a leading question, but were you talking about this gap? I mean, the gap may be for all sorts of reasons. It may be simply because there is an insufficient pool of financing available, or it could be because there are not enough investors who are prepared to take that particular position. I mean, so briefly, how would you draw a distinction between a situation where all the right people are investing but they're not coming up with enough money, as opposed to a situation where people are avoiding it because it's not something they would wish to invest in, more generally?
Yeah, that's a good question. I would say that we will cover, first of all, we will cover both political and commercial risk in terms of when we are looking at the cause of the gap, so to speak. So we practically, the way we try to find a solution for the question, the dilemma that you've outlined, is that we will work with financial partners, and by that I mean usually commercial banks. So there will be, for example, typically for capital investment projects, there will be a financial advisor, and we will work with them to outline what the nature of where we can best add value. Is it by expanding the quantum of funding that has been made available, or is it by reducing the overall cost of funding? And our view is that by we try to be as commercial as we can, we are a step away from the financial markets, and by having a commercial bank or another non-bank financial institution working with us, then we make sure that we are not undercutting the commercial markets, because we don't want to do something that the commercial market is happy to do. But at the same time, we don't avoid projects which actually there is good merit in them. It's just a case of sometimes you just need an aggregator or purana, which our presence actually performs.
Excellent. Thank you very much. Brilliant. We've heard some very interesting analysis of the kind of issues which may put people off. You kindly volunteer to operate or to comment on how those risks might be mitigated and how you would approach a situation which might be challenging.
Yeah, first of all, thank you for the organizer for the invitation, for you, Simon, and also for this panel specifically. Yeah, I mean, we advise a handful of money majors on the acquisition strategy, and especially institutional investors, not then hand, but probably would be aligned a lot in terms of my position on this, both in Europe and in the Middle East. And I think when we actually look at the region of Central Asia and how to mitigate those risks, obviously you have to drill down on a series of what are those risks. I mean, there are absolutely some positive aspects of the regions compared to some other regions in the world, and there are clear capacities in terms of operational capacities in the region. There's quality infrastructure when you compare it to Africa or to Latin America, which is much more complex in terms of building the infrastructure. There's quality workforce, as I mentioned. There's also a lack of not so much community opposition. I mean, there's no signatories, for example, of the ILO 169, which is a big issue in Latin America, where you have to have clear informed consent, prior to any kind of investment decision. That's not something that you have to face in Central Asia. But at the same time, there are some clear worries. There are some limitations that actually are both present for European investors and Middle Eastern investors in terms of the region itself. We've talked about, in other panels, elements of geopolitical risk. I'm not going to go into more details than what was mentioned. There are, the Russian influence. When you look at Kinross, the decision they had to take a debacle that led to it. Obviously, it has kind of informed clear worries from many majors onto the regions. The central gold also issue, obviously, and I know all countries are very different from one to another, but that gave a bad rep to the region as a whole, when trying to encourage institutional investors to look at a new region, and you have some this one obviously that kind of scared them away. Where I think it's where I might differ from Berg, I actually have 90% in agreement with you, is probably on the ESG approach to it. And I think when you're looking at ESG today, it's different from what we were talking 10 years ago. 10 years ago it was about maybe social license to operate, indeed, maybe kind of supporting 2 or 3 projects in terms of coffee growers in Colombia and making sure that the indigenous communities will not be too much impacted in Peru to avoid the roadblocks. Right now we're much more looking at more systemic approach to both environmental, social and governance performance of different companies. And that's where probably the region is lagging on a series of those issues. We've seen a lot of different countries, and we're implementer of TSM from the Canadian Mining Association, especially in different countries, so towards sustainable mining. You have a series of agreements between countries in Latin America, whether it's Colombia, Brazil, Argentina, and implementing those different protocols in tailings, in water use, in social governance, and so on. You also have agreements with Australia, even Botswana in Africa, and a series of other African countries looking at this. Central Asia is nowhere on the map in terms of trying to be able to build some kind of those partnership that will reassure investors. I think that the key element here is an element of reputational risks. Whether you're looking at political instability in a country, or you're looking at potential, let's say, negative impact of an environmental risk, no investors now is ready to put $100 million or sign large supplying agreements in a country where you don't have the security that you will not be put back in bag, let's go this way, by a reputational impact. I mean, looking at French banks who've been working, there's so many impacts on the investment in terms of coal, in terms of fossil fuel. The same thing happens when you invest in countries where there's no clear social license to operate, or clear ESG guidelines in terms of how to operate those mines. So it needs to be very clear in terms of reporting systematically on the series of protocol, not only on a few ESG or corporate social responsibility projects, but really having an integrated systematic approach to ESG in terms of all your functions, whether it's communication, human resources for local content, for example, environmental mitigation of risks. And that's where there needs to be potentially more discussion between either European governments or Canadian governments and Central Asia in terms of implementing those frameworks that will reassure more generally institutional investors. And even when we're talking about family offices in the Middle East, for example, it's all about reputation. It's all about being part of a large supply chain. So that means also not only having the minerals for the processing into the Saudi Arabia, for example, but also being able to sign agreements with Tesla, BMW, Samsung, and they will not be signing agreements with those countries or those family offices if the mineral is not sustainably harvested. So I think that's where it comes first from the framework, and then being able to adapt it, implement it, regulate it, and report it steadily.
I think you had a...
Yes, I wanted to add to what you said, because I agree in terms of the structural approach. And I think what Bert is where I think you're right is that a lot of many parties value just mention ESG as an umbrella term for absolutely everything. And that's why it becomes just an empty buzzword, because it's everything and anything. Then
we have never said it's empty. We also have ESG policies. All I'm saying is responsible operators, responsible operating in the mining industry was always necessary for success. So that is not a new thing.
Fine. So what I think is important is to really understand what goes into ESG. So environmental reporting and disclosure of climate-related financial disclosure is super important. So it's not just a separate report. What we're now asking companies to do is actually integrate a report. What is company doing on every level of its operations, from the board of directors into the operation on the ground? How is this actually, how do they implement climate policies and sustainability policies across the board? I think that's from the environmental perspective. Secondly, on the social impact, we can't deny the impact that mining companies have on the society around them. And of course, a lot of the companies that we know, they try and they create favorable environment for the communities around them. Schools, they sponsor certain projects and so on. But the social aspect is really important, and how that connects to what they do on the ground. And then governance, of course, you mentioned tailings. I think governance was around risk management, tailings management, and how the decisions are made and how the decision making is governed from the executive board level throughout the operations management is hugely important. So I agree that it's really it's become fashionable to just say we're ESG compliant, right? But I think what investors are really looking for is this real elements and how do you deliver against the specific elements of the ESG, especially for mining companies around sustainability strategy.
Maybe I'll just rebound on this, and I think the key changer is that now the ESG trend is coming from the end user. It's not only coming from the investors, it's coming from either the end users in terms of the company that will actually use the mineral processing supply chains. Completely agree with whatever Bert was saying until then. Actually, my only worry is that he was saying exactly what I wanted to say more eloquently than I would ever say it, so that was my main worry. But I think here, when you look at a series of standards, and especially minerals per minerals, if you're a copper producing company now, the copper mark is probably arguing that 50% of main copper producing companies in Latin America, for example, have adopted the copper mark. EMI is another standard that is actually really hard to implement because it's kind of encouraged by NGOs rather than the company that the industry itself. So it's kind of hard to be able to put in place. But we can't just go with even in the responsible gold mining principle from Model Council. I like the team, but it has to be a little further. And the problem is not everyone has cell phones. I'm not saying cell phones for the company. I'm saying any kind of environmental damage, any kind of social disruption is going to be blown out of proportion sometimes, or it's going to be just communicated, or sometimes blown out of proportion. And you need to be able to make the point that your operation is extremely sustainably run. And if not, then investors are going to be shying away from it because they're afraid of their reputational impact on their own share value, on the impact they will have on BNP Paribas, on Société Générale, or any other banks, for example. And that's where you have to be extremely cautious of this systemic approach of basically reading ways. But I agree with you, yes.
Thanks very much indeed. And I think we've all avoided using the word greenwashing, but it's clearly another buzzword which is coming down the tracks a bit. I'd like to come in a moment to ask you about the voluntary carbon market. But just before we do that, can I, and then we'll open the questions on the floor. We've been discussing equity investment, debt investment, and export credit as part of that. What role do you think that off-take financing, forward sales, and things like that, what role do they have to play? Is anyone happy to comment on that?
Yeah, quickly, because for me it's a relatively easy one. From a debt finance point of view, offtake is critical for a project financing. If you are looking to finance a mining development on a non-recourse or limited recourse project financing basis, if there is no long-term offtake, we will not get there. Yeah. It's make or break.
Okay, and I guess that. We haven't really sort of gone down that particular avenue, but clearly there's a difference between financing what we start with the jurisdiction and then the individual companies and of course the individual projects beneath that. But things like forward sales where effectively much of the production is sold in advance to an off-taker, is that something you're seeing more? I mean, obviously we understand that you need there to be off-take as a source of revenue going forward, but things like forward sales, is that part of the financing rules you operate?
Yes, Simon. So what happens in practice, depending on the size, but it's not unusual to have a combination because from the equity standpoint and from the mining group standpoint, they want to not lock themselves into prices on a forward basis. But then it becomes a debt sizing exercise where we almost back solve and say that okay, actually, you know what? If 40% is locked in either through forward sales or long-term offtake, that services the debt, and the rest can you can do whatever you want. So typically that's what we see. But for us, For us, it's very, but almost, I don't even want to say difficult. We won't get comfortable with a structure which expects debt providers to just rely purely on market risk, i.e. 100% free throughout.
I would say the more esoteric the metal or more niche the metal, also from an equity point of view, right? You'd actually want to have offtake agreements, right? Because while copper is a commodity, the truth is most of these battery metals are not commodities, right? Like graphite, high purity manganese, etc., etc. So also, if you didn't have an offtake solution in place there, frankly speaking, there's no investment case, right? If it's a really deep liquid market like copper, so that's maybe a little different, right? But in a lot of those metals are minerals that actually address the needs of the energy transition today, right? These are very complicated metals that require very complicated downstream processing. So there is actually no upstream investment case if there were actually not offtake clearly in place.
Thank you. I don't know if you want to talk briefly about the voluntary carbon market, please.
Yes. At COP26 last year in Glasgow, we made a commitment to create the voluntary carbon market, specifically from the primary market perspective on the London Stock Exchange, enabling funds and operating companies to raise primary capital with the CMS designation that actually leads to the creation of new carbon credits. And we delivered that, and in October, so last month, we launched that. And the premise is that the London Stock Exchange has this convening power, and we bring together those who need capital, those who provide capital, and all of this in service of an objective, which is a just transition to net zero. And so this new designation, it enables, as I mentioned, funds and companies to connect with those investors who want to participate in the creation of new carbon credits, not the existing ones that are traded on the secondary market, new ones. And these are projects that are truly active. And then these companies and funds can then pay dividends either with carbon credits or in specie, with carbon credits or in cash. And then investors have a choice then to retire those carbon credits or to sell them on in the market. So that's one important thing that I think will enable companies from actually all sectors to participate in this. So you don't have to be a renewable energy company per se, but you could be a company that creates a specific fund just for this purpose. So that's.
And where can people find out more about this or not?
It's well, get in touch with me, or it's online as well. It's London Stock Exchange's voluntary carbon market. It's available there. And I've just actually recently, I don't know if they're here actually, I've been talking to a Kazakh company that create humus, organic humus, out of coal that we mine in Kazakhstan. And that's an additive project. So that could qualify for the
Fantastic. We've also been covering in the last 40 minutes or so what could take at least one day on a follow-up basis, but we've got a few minutes before I get sort of definite from Arthur. So any of you have any questions you'd like to put to the panel, please?
That's a question for Bobby.
One moment, please. Coming in your right.
Just shout. On the export credit back financing, so are you guys putting your own money in, or are you just guaranteeing the bank debt?
So we do both. We have a direct lending, what we call direct lending facility, as well as bank guarantees. The principal form of our support comes through bank guarantees, because direct lending, by definition, because actual pound and pence leaving the country, that's a finite pot. So we want to disperse it into across as many projects as we can. So that effectively gets rationed. But we can do both.
You doing any credit wrapping?
Sorry?
Credit wrapping?
Yeah, yes, yeah, you can do that.
He's got his checkbook here.
Simon, I have a suggestion. You've got someone in the room from EBRD. Maybe they would want to have any comments. I don't know. I think I should have seen a few faces. from EBRD at lunch.
Yes. I did accost him earlier and he wasn't over enthusiastic about it.
Well, thank you very much. I just want to say that actually we have two hats, one of debt and equity, so we look at the projects from different perspectives. And mostly from the risk perspective, so depending on what the project risks, national credit risks, institutional risks, etc. So we consider what would be the best financial instrument. So it's more like a tailor-made solution itself. And in our kinds of operations, most of them emerging countries, the most simple way would be like that project, the corporate lending unsecured. But sometimes we have projects at the early stages, pre-development, and we do like large equity investment as well. So in terms of the requirements, I think the most critical part. We talk about a lot about the social license to mining, and we pay a lot of attention. And this is the most time-consuming, and we consider it like more investment. It's investment in environmental and social standards. So we do invest only when we are comfortable with the environmental and social risks. And this is a very important point for us and for our board when we consider any mining projects.
Thank you very much.
Thank you.
Please.
Yeah, just an additional comment. We have plenty of wonderful experts on European sources of financing, so I won't go there. I'm thinking about potential opportunities for good projects in Central Asia, which are potentially pulling fundings from the Middle East, from Saudi Arabia or Qatar. They're very different, approach to it. Saudi Arabia is obviously mainly focused on developing the Saudi mining sector and making a hub out of it, but they want to develop the entire value chain in terms of mineral processing. And we've seen some actors interesting to partner with family offices to actually build long-term partnership in terms of bringing know-how of how to develop the mining sector in Saudi Arabia and building a partnership towards maybe some projects in other countries. We've seen this with Latin America, we've seen with some initiatives towards Africa. The idea is to actually, and I think Nathan Williams said he did it better than I did, in terms of being part of a completely mineral supply chains and transformation chain and playing the long game. Then there's a road there for potential producers and project developers in Central Asia. That has to be done in terms of a win-win partnership in terms of developing the minerals in the long chain.
Thank you very much. Arthur is now standing menacingly over there, so I think we have to bring it to a close. But I'd like to thank the panelists very much indeed for producing at very high speed a lot of very interesting issues, and I'm sure they'll be more than happy to have discussions in the 10-minute technical break now, or over a soft drink later on this afternoon. Thank you very much.
Thank you very much, Simon.